What is the bid-ask spread on the stock market? Imagine walking into a busy marketplace where vendors are shouting out prices for their goods. Some are willing to sell at one price, while buyers are shouting out what they're willing to pay. The difference between these two prices is what we call the bid-ask spread. It's a simple idea but plays a big role in how stocks are bought and sold on the stock exchange. The bid price is the highest price a buyer is willing to pay for a stock or an option. Think of it as the maximum amount someone is ready to spend. The ask price is the lowest price a seller is willing to accept. It's the minimum they want to get for their stock. When you want to buy a stock, you usually pay the ask price. When you sell, you usually get the bid price. The difference between these two prices is the bid-ask spread. This spread acts like a hidden cost in trading. If you buy a stock at the ask price and sell it immediately at the bid price, you'll lose the amount of the spread. It's a cost traders need to consider, especially for quick trades or small price movements. The size of the spread can tell you a lot about how active or liquid a stock is. In markets where many people are trading a stock, the bid and ask prices are very close. This results in a narrow spread, which means lower costs for traders. Stocks with high trading volumes tend to have narrow spreads because there are lots of buyers and sellers. On the other hand, stocks that don't trade as often or are more volatile usually have wider spreads. This is because market makers and liquidity providers need to protect themselves from higher risks, so they set wider gaps between bid and ask prices. Market makers are the traders or firms that keep the market moving by constantly quoting prices. They earn the spread as their profit for taking on the risk of holding stocks. Electronic trading platforms also have limit order books, where buy and sell orders sit waiting. The spread depends on how many orders are there and how balanced the market is. In options trading, the bid-ask spread can be even wider. Options are more complex and less traded than stocks, so the spreads tend to be larger. This means traders need to pay extra attention to the spread because it adds to their overall trading costs. Understanding the bid-ask spread helps you see how liquid a market is and how much it costs to trade. Narrow spreads mean you can buy and sell more easily and with less expense. Wide spreads suggest less activity and higher costs. Knowing this can help you decide when to enter or exit a trade and how to manage your expenses better. It's a simple but powerful part of understanding how the stock exchange works and how markets are structured.